I think there are very few great investments at any one time. So the ability to concentrate is an enormously valuable asset of a strategy. The problem with it is it leads to bumpier returns. And it leads to more attention on mistakes or things that aren't going well. I don't know a portfolio manager that doesn't have a stock that's down in his portfolio, right? But you don't read articles about, we're getting an awful lot of attention for a pretty high-profile situation that's struggling. But I think there's, it depends on what your business model is. But if you want to make high rates of return over a long period of time, it's hard to do that being very diversified.
I started as an investor. I raised the first pool of capital when I was 26, and I made an early investment in a company called Rockefeller Center Properties. And I saw management making a series of decisions that made no sense to me. And it was just so obvious the right thing to do as to how to create value. And it was being a frustrated passive investor that made me into an active investor. And that investment turned into a very profitable and very high-profile investment. And with success, one is motivated to try it again, and it's been helpful to the strategy over a very long period of time, and it's fun. And if you're passive, you can feel like the market's patsy, and if you're active, you can actually create some value. And I think it's a lot more interesting than just picking securities. We bought a stake in Chipotle at a time where the company was struggling a few years ago. We put a few directors on the board. We recruited a new CEO named Brian Nickel. It's completely turned around the company. The stock has almost tripled in the midst of a crisis, and it just tells you that that's a lot more fun and it's a lot more profitable, and it's, I would say, a lot more good for America than just simply being a passive stock picker.
If you believe that the value of anything financial is the present value of the cash you can take out of it over its life, well, you need to know how much cash it's going to generate over its life. So business quality to us is the single most important criterion for determining what's interesting. Because if we can't predict the cash flows, we don't know what it's worth. If we don't know what it's worth, we can't invest.
I feel very comfortable owning 10 phenomenal businesses. If the stock market shut for 10 years and we woke up 10 years from now, those companies would be a lot more valuable. And you can't say the same thing about bonds. I do think interest rates are largely bounded by zero. Not entirely bounded by zero, but betting on rates going negative is a short-term trade, not a long-term one.
Yeah. And the problem with short selling is it's still not accepted as particularly well accepted as an American way of investing. There seems like something inherently shadowy or evil about short sellers.
And so I do think we are set up for a very strong recovery in 2021. I think the virus is going to be frightening and a disaster for the next, call it 90, 120 days. So that's the big negative news in the short term. But we have multiple successful vaccines and probably more coming. We're going to have fairly wide distribution of those vaccines. By the second half of next year, we'll be probably out of the pandemic for the most part in the first, kind of what you might call first world. So I think there's a pretty good chance for a very strong stock market next year. The stock market, as I like to say, is not a fair representation of the global economy. It's an important reflection of the global economy, but it doesn't represent the smaller, less well-capitalized, less well-technologically enabled companies. Think private, family-owned, smaller, up-and-coming businesses. The S&P 500, for example, represents probably the 500 most dominant companies in the U.S. and in some cases in the world. What COVID has done and what the pandemic has done is it's really disrupted, the companies with bad balance sheets without being technologically enabled have been impaired. Many of them, unfortunately, the smaller ones have gone out of business, whereas the well-capitalized dominant companies have actually improved their market position. So, surviving a pandemic or having the ability to survive a pandemic puts you in a strong competitive position coming out of it. And so you think, simple example, Starbucks is a significant holding. Think about how many fewer coffee shops they're going to be competing against. There's sort of 8 principles that have driven our investment success. And when we have veered from those 8 principles, we've lost money. And after we went through a very difficult period, circa 2015, 2016. The 2 investments you mentioned were big drivers of that. It was, if you will, experiences making mistakes and learning from them. And it was a moment of reflection for the firm. And I went back to the core principles that have driven our success for the first 12 years. And I had a member of the investment team literally engrave them in a stone tablet, not dissimilar from Moses' 10 Commandments. And I had that stone tablet put in what you might call a deal toy, sits on everyone's desk in the office. And we've adhered to those principles, ever since. And we've been fortunate to return to the success we had for the first dozen years. So if you don't know what you want to own a lot of things. Our business is different. We own 10 things. We tend to own them for years. We have some holdings we've owned for a dozen years, some 8 years, 4 years, 6 years. We're looking for businesses we can own for. The whole goal behind getting permanent capital is we never wanted to be forced to sell something because of investor capital flows. We're now in that position as 87% of our assets are in Pershing Square holdings. So one, we have the time to do our homework. We might identify 1 or possibly 2 new investments a year. Second, of course, these are businesses we've gotten to know quite well over time. But most importantly, we've selected businesses for their inherent robustness, right? So almost all of our companies are strong investment grade companies, so there's not a balance sheet threat to the businesses we own. They tend to be very dominant, whether it's Hilton or Starbucks in their respective industries. So they're an important, dominant, large cap business. They're in businesses that we can understand, and they're businesses that we think are not at great risk of disruption. And that we spend big part of our job is saying how we're looking for the highest quality businesses in the world.
The best investments are the ones where we are confident we're right and everyone else is wrong. If you're arrogant in investing, you're going to get killed, right? If you're not confident, you'll never make an investment, right? So you have to do a sufficient amount of work to be confident enough to have the conviction to do something that's contrarian.
And so if you own 10 stocks that were sensitive to energy prices or interest rates or regulatory risks, or they had highly levered, then you've got enormous risk. If you own 10 incredible businesses with strong balance sheets and excellent management teams, and you're a large influential shareholder, so you can encourage them to do smart things and you can discourage them or prevent them from doing things that would be destructive, you're actually better off owning a concentrated portfolio and owning the 10 best things you can find than even owning 20 things where we're not going to, ideas 11 through 20 are not going to be as good as ideas 1 through 10. And that's really the strategy. Our principles are basically, we want to invest in simple, predictable, free cash flow generative, dominant companies with large barriers to entry that earn high returns on capital, that have limited exposure to extrinsic risks we can't control, strong balance sheets, don't need access to capital to survive, have excellent management, good governance. Sounds logical, but occasionally we've diverged, and there's those times, there's a certain discipline that comes with investments, and there always seems to be a countervailing quality that caused us to diverge. But in really each case where we've compromised on business quality or complexity, we've been harmed.